September 23, 1998, 9 a.m., the boardroom at the Federal Reserve Bank of New York. 16 CEOs sat around the table. Goldman Sachs, Morgan Stanley, Merrill Lynch, J.P. Morgan, Bankers Trust, every major Wall Street firm. They had been summoned with less than 24 hours' notice. The message: get here or face consequences you cannot imagine. The Federal Reserve official opened the meeting with a simple statement. Long-term capital management is hours away from bankruptcy. If it fails, it will trigger a cascade of liquidations across global markets. Your firms will be next. The entire financial system could collapse by Friday. The room went silent. LTCM wasn't a bank. It was a hedge fund. A private partnership managing $4 billion. How could a single hedge fund threaten the entire system? The answer: derivatives. LTCM held positions with a notional value of $4.6 trillion, $4.6 trillion. That's more than the entire GDP of Japan at the time. All controlled with $4 billion in equity through derivatives contracts spread across every major financial institution in the room. If LTCM defaulted, every counterparty would simultaneously try to unwind trillions in positions. The forced selling would crash bond markets, equity markets, currency markets. Liquidity would disappear, prices would collapse, margin calls would cascade, bank after bank would fail. The 1929 scenario, but global this time. The Fed official laid out the only option. The banks in this room will collectively contribute $3.6 billion to stabilize LTCM. You will take over the fund, you will unwind the positions gradually, or you will all face catastrophic losses when markets collapse Monday. By end of day, the consortium was formed. Wall Street's biggest competitors agreed to bail out a hedge fund to save themselves. The deal wasn't altruism, it was survival. LTCM had become too interconnected to fail, and too big to fail was born not with banks in 2008, but with a hedge fund in 1998. This is the story of how the smartest people on Wall Street, including 2 Nobel Prize winners in economics, built a financial weapon of mass destruction using mathematics they claimed was foolproof. How genius and leverage created systemic risk, and why the lessons from 1998 were completely ignored, leading directly to 2008 and beyond. Understanding LTCM matters because it reveals how derivatives hide risk, how smart people become overconfident, and why this time is different is always a lie. Long-term capital management was founded in 1994 by John Merriweather, a legendary bond trader who had run the fixed income arbitrage desk at Salomon Brothers. Merriweather's group at Salomon had been phenomenally profitable through the 1980s and early 1990s, exploiting tiny pricing inefficiencies in bond markets using sophisticated mathematics and heavy leverage. In 1991, Merriweather left Salomon after a treasury auction scandal involving one of his traders. By 1993, he was planning his comeback, not as an employee, as the founder of what would become the most sophisticated hedge fund ever created. Merriweather recruited aggressively. His partners included Myron Scholes and Robert Merton, who would win the Nobel Prize in Economics in 1997 for their work on options pricing theory. The Black-Scholes model revolutionized derivatives trading. Having its creators as partners gave LTCM unmatched credibility. If the Nobel Prize winners believed in the strategy, how could it fail? Other partners included David Mullins, former vice chairman of the Federal Reserve, Eric Rosenfeld, Harvard professor, Larry Hillebrand, mathematics prodigy from MIT, Victor Haghani, trader from Salomon, Greg Hawkins, another Salomon veteran. The team combined academic brilliance with trading experience and regulatory connections. Wall Street had never seen such concentrated expertise. LTCM's strategy was Convergence arbitrage. The idea: find pairs of similar securities trading at slightly different prices. Buy the cheaper one, short the expensive one. As prices converge, which they should because the securities are fundamentally similar, capture the spread. Use massive leverage to turn tiny spreads into large profits. The classic example: on-the-run versus off-the-run Treasury bonds. When the U.S. Treasury issues new 30-year bonds, the previous 30-year bonds become off-the-run, less liquid but fundamentally identical in credit quality and maturity. The new bonds typically trade at a slight premium because they're more liquid, maybe 5 to 10 basis points higher. LTCM would short the new bonds at, say, 100.10 and buy the old bonds at 100.00. When the premium narrowed over weeks or months, which it always did eventually as the new bonds became less new, they'd capture that 10 basis point spread. On $1 million position, 10 basis points is only $1,000 profit, hardly worth the effort. But on $1 billion position levered 25 to 1, that's $250 million in exposure for $10 million equity. The 10 basis point spread becomes $250,000 profit on $10 million invested, a 2.5% return. Do that trade 100 times across different maturity bonds with different timing, and suddenly you're making spectacular returns on seemingly safe arbitrage. The brilliance was using quantitative models to identify these opportunities across hundreds of markets simultaneously. U.S. Treasuries across the entire yield curve, European government bonds, German Bunds versus French OATs, Italian BTPs versus Spanish Bonos, Japanese government bonds, mortgage-backed securities issued by Fannie Mae and Freddie Mac, stock index futures where cash and futures prices diverge slightly, equity volatility where implied volatility from options pricing seemed high or low relative to historical volatility, currency swaps exploiting interest rate differentials. Anywhere two similar things traded at different prices, LTCM found the spread and bet on convergence. The mathematical sophistication was unprecedented. They built models that could analyze thousands of securities simultaneously, identify mispricings measured in basis points, calculate optimal position sizes, and manage risk across a global portfolio. The computers and algorithms they developed were years ahead of competitors. This wasn't gut feel trading. This was pure quantitative finance, executed by the world's best. The strategy seemed safe. They weren't betting on markets going up or down. They were betting on spreads narrowing, a mean reversion trade based on fundamental relationships. The math said these spreads couldn't stay wide forever. Historical data confirmed it. And with Nobel Prize winners designing the models, confidence was absolute. But the strategy required leverage, massive leverage. The spreads they were capturing were tiny, often a few basis points. To turn basis points into meaningful returns, you need enormous positions. If you make 0.5% on a trade, but you're levered 25 to 1, that becomes 12.5% return on equity. The leverage magnifies the tiny edges into spectacular profits. LTCM launched with $1.25 billion in capital in 1994. Investors paid a steep price to enter, 2% management fee plus 25% of profits. Typical hedge funds charged 1% and 20%. LTCM demanded more because the team was that good. And investors paid gladly. The minimum investment was $10 million. Partners themselves invested $100 million. This wasn't a fund for retail. This was an elite partnership for the ultra-wealthy and sophisticated institutions. The first years were extraordinary. 1994, 20% return after fees. 1995, 43%. 1996, 41%. 1997, 17%. Investors made fortunes. The fund grew from $1.25 billion to over $7 billion by early 1997. LTCM became the most celebrated hedge fund in history. Returns that beat the market consistently with supposedly low risk. The perfect investment. But growing from $1.25 billion to $7 billion created a problem. The arbitrage opportunities LTCM exploited were limited. There are only so many mispriced treasury spreads. As the fund grew, they faced a choice: find new strategies or return capital to investors. They chose a third option: increase leverage and return most of the profits to investors to keep the fund at optimal size. In late 1997, LTCM returned $2.7 billion to investors, keeping the fund at about $4.8 billion. But they didn't reduce positions proportionally. They maintained the same exposure with less capital. The leverage ratio exploded. By early 1998, LTCM had $125 billion in assets on $4.6 billion in equity. That's 27-to-1 leverage. But that's just on balance sheet. The derivatives positions were off balance sheet. The notional value of derivatives contracts exceeded $1.25 trillion by some estimates. Others suggest it reached $4.6 trillion at peak. The exact number is debated, but the scale was monstrous. The firm had swaps with every major bank. Interest rate derivatives, credit default swaps, equity index swaps, currency forwards, options on everything. The positions were so large that LTCM was a significant counterparty to every major financial institution globally. They had become systematically important without anyone realizing it. The model said this was fine. Historical volatility was low. Correlations were stable. The spreads they were betting on had never stayed wide for long. The math showed their value at risk was acceptable. The Nobel Prize winners had stress-tested the portfolio. The risk appeared managed, but the models made assumptions. They assumed markets would remain liquid, that positions could be unwound if needed, that historical relationships would hold, that extreme events, tail risks that were so improbable they could be ignored. The models were built on data from stable periods. They had no data for true crisis. August 17, 1998 changed everything. Russia defaulted on its government debt. The devaluation of the ruble and default on domestic bonds wasn't entirely unexpected. Russia's economy had been struggling since the 1997 Asian financial crisis spilled over. But the magnitude shocked markets. Russia didn't just devalue, it imposed a 90-day moratorium on debt payments. Government debt, corporate debt, everything froze. And the response was panic. Investors fled anything risky. They sold emerging market bonds, Brazilian, Argentine, Turkish. Debt all crashed. Corporate bonds, high-yield debt, anything with credit risk. They bought the safest assets, U.S. Treasury bonds. The flight to quality was instant and massive. Money poured into treasuries regardless of price. Yields on 10-year treasuries fell from 5.5% to below 4.5% in weeks as prices surged. For LTCM, this was catastrophic. Their convergence trades assumed normal market behavior, that similar securities would trade at similar prices, that spreads would mean revert, that liquidity would exist. But markets weren't behaving normally. Spreads that should narrow were widening violently. The on-the-run versus off-the-run treasury spread, which LTCM bet would narrow, exploded wider. Investors panicked into the most liquid bonds regardless of price. The less liquid bonds LTCM owned became impossible to sell without massive losses. The spread that should have been 5 basis points went to 20, then 40, then 60. LTCM was short, the bonds rising in price, and long, the bonds falling. Every day the spread widened, they lost money on both sides. Mortgage-backed securities spreads widened brutally. These securities, pools of home mortgages packaged and sold, normally trade close to treasury yields, plus a small spread for credit risk and prepayment risk. LTCM owned mortgage-backed securities and had hedged the interest rate risk with treasury shorts. But in the panic, investors sold mortgage securities aggressively while buying treasuries. The spread that should have been 80 basis points over treasuries went to 120, then 180. LTCM's hedges weren't working because the correlation broke. Mortgage securities and treasuries were supposed to move together. Both are long-duration bonds. But in crisis, only treasuries were bid, everything else was offered with no buyers. Corporate bond spreads blew out. Investment-grade corporate bonds that normally traded 60 to 80 basis points over treasuries went to 150 to 200. High-yield bonds, already wider spreads, went from 400 to 800 basis points in weeks. Equity volatility spiked. The VIX index measuring implied volatility on S&P 500 options jumped from 20 to 45. Every convergence trade LTCM had was moving against them simultaneously. Positions that were supposed to be uncorrelated because the model said different markets shouldn't all move together were now perfectly correlated. Everything risky was selling off together. Everything safe was being bought together. The diversification that LTCM's models relied on vanished. The fund wasn't holding 100 uncorrelated small bets. They were holding one giant bet that markets would behave normally, and markets had stopped behaving normally. The losses mounted daily. August 17th to 21st, $553 million. The entire month of August, $1.85 billion, nearly 40% of the fund's capital gone in 2 weeks. September was worse. The problem wasn't just losses, it was liquidity. LTCM couldn't exit positions. The markets they traded were freezing. Bid-ask spreads widened to levels that made trading prohibitive. And even if they tried to sell, the positions were so large they would move the market against themselves. They were trapped. Counterparties started demanding more collateral. As LTCM's equity declined, margin calls arrived from every bank they traded with. They had to post billions in additional margin, but doing so depleted their remaining capital further. A death spiral began. By early September, LTCM had lost over half its capital. The fund that started 1998 with $4.6 billion was down to $2.3 billion. The leverage ratio, which was already extreme, was now apocalyptic. The remaining equity was supporting $125 billion in balance sheet assets, plus trillions in derivatives exposure. Merriweather reached out to investors. He needed capital urgently. Billions. Warren Buffett's Berkshire Hathaway considered a rescue. George Soros looked at the positions. But the situation was too complex. The positions were too large. The counterparty exposures too tangled. Private rescue efforts stalled. By mid-September, LTCM faced margin calls it couldn't meet. If they defaulted, every counterparty would simultaneously liquidate collateral and close out derivatives positions. The forced selling across global markets would be unprecedented. Treasury markets would crash, credit markets would freeze. The cascade would be unstoppable. Wall Street's banks suddenly realized they had a collective problem. They were all exposed to LTCM through derivatives. If LTCM failed, they would all be scrambling to unwind identical positions simultaneously, crashing prices and triggering more margin calls in a doom loop. The Genius Hedge Fund had become a systemic bomb. The Federal Reserve intervened not because LTCM was a bank, but because its failure would take down banks. Fed President William McDonough orchestrated the September 23rd meeting. The message to the 16 CEOs was stark. LTCM's counterparty exposure to your institutions is so large that if they default tomorrow, your firms will face billions in immediate losses. And those losses will trigger margin calls across the system that will cascade into a 1929-style meltdown. The math was brutal. LTCM had derivatives contracts with notional values in the trillions spread across every firm in the room. If LTCM defaulted, every counterparty would simultaneously try to hedge or close out those positions. But they'd all be trying to execute the same trades, selling what LTCM was long, buying what LTCM was short. The market impact would be catastrophic. For example, LTCM was long hundreds of billions in off-the-run treasuries. If they defaulted, counterparties holding collateral would dump those bonds simultaneously. But who would buy? Everyone would be selling, prices would crash. That would trigger margin calls at other hedge funds and banks holding similar positions. Those firms would be forced to sell too. The doom loop would accelerate until the treasury market, the safest, most liquid market in the world, seized up completely. The same dynamic applied across every market LTCM traded: European bonds, mortgage-backed securities, equity swaps, credit derivatives. The forced liquidation would propagate across global markets in hours. And because it was a Friday afternoon, if they didn't stabilize LTCM by market close, the panic would build over the weekend. Monday would open with gap-down crashes across every market. Banks wouldn't survive. 14 banks contributed $3.625 billion total. The breakdown: Bear Stearns, Chase Manhattan, Credit Suisse, First Boston, Deutsche Bank, Goldman Sachs, Merrill Lynch, J.P. Morgan, Morgan Stanley, Salomon Smith Barney, UBS, and others. Each contributed between $100 million and $350 million based on their exposure to LTCM and their balance sheet size. In exchange, they received 90% ownership of LTCM. The original partners, including the Nobel Prize winners, saw their billion-dollar stakes reduced to 10%, essentially wiped out. The consortium took control immediately. The mandate: unwind the positions gradually without crashing markets. It took months. Some illiquid positions couldn't be closed for over a year. The markets were that broken. But by unwinding slowly and waiting for spreads to normalize, the consortium actually made a small profit by the time LTCM was fully liquidated in early 2000. The bailout worked financially. The system was saved, but the precedent was catastrophic. The lesson Wall Street learned was, if you're big enough and interconnected enough, you'll be rescued. The moral hazard was explicit. Take massive risks. If it works, keep the profits. If it fails, the system will bail you out because it has no choice. When the London gold pool closed in March 1968, there was no warning. Investors woke up and the market was locked. No gold available, no conversion. Done. We created the 7-stage collapse survival guide so you never get trapped when the window closes. It shows you exactly when to move your wealth into assets that survive collapse, before banks freeze, before governments confiscate, before inflation devours your savings, while you can still act. Access it at https://pay.hotmart.com/B1033628117 ELTCM's collapse. Revealed multiple systemic failures. First, derivatives allowed a small fund to create massive systemic risk invisibly. The $1.25 trillion in notional derivatives exposure wasn't on any balance sheet regulators could easily see. The risk was hidden in bilateral contracts between LTCM and counterparties. No central registry, no transparency, just trillions in interconnected bets spread across the system. Second, mathematical models created false confidence. The Nobel Prize winners believed their models captured risk accurately. But models are only as good as their assumptions and data. LTCM's models assumed liquidity would always exist, that historical correlations would hold, that extreme events were rare enough to ignore. When assumptions broke, when Russia defaulted and correlations went to 1, the models were useless. Third, leverage magnifies everything. Small losses become catastrophic losses when you're levered 25 to 1 or higher. LTCM's strategy wasn't fundamentally flawed. Convergence arbitrage works. But the leverage they used meant they needed everything to work perfectly. A small adverse move, which would be survivable with less leverage, became terminal when magnified by extreme borrowing. Fourth, the smartest people aren't immune to disaster. LTCM had more brainpower per square foot than anywhere in finance. Nobel Prize winners, PhD mathematicians, former Fed officials, legendary traders, and they still blew up spectacularly. Intelligence doesn't prevent failure if the assumptions are wrong or the leverage is too high. Smart people often fail more dramatically because they're confident in their models and willing to bet bigger. Fifth, too big to fail isn't about size alone. It's about interconnectedness. LTCM was a $4 billion fund, tiny compared to major banks. But through derivatives, it was connected to every significant financial institution. The web of counterparty relationships made failure unacceptable. Size mattered less than connectivity. The aftermath saw minimal regulatory change. Congress held hearings. The President's Working Group on Financial Markets issued a report. Recommendations were made about derivatives transparency and leverage limits, but nothing substantive happened. Wall Street lobbied successfully against regulation. The argument, LTCM was an isolated incident. The system worked, the bailout prevented contagion. Don't overreact with regulation that will stifle innovation. This was the critical mistake. The correct lesson from LTCM was, derivatives create hidden systemic risk, leverage turns small problems into catastrophes, and interconnected positions guarantee contagion. The system got lucky in 1998 that the Fed could organize a bailout before markets opened Monday. But luck isn't policy. Instead, the lesson Wall Street learned was we can take bigger risks because the Fed will rescue us. The moral hazard was explicit and intentional. Banks became even more aggressive with derivatives. Leverage increased, complexity grew. The same dynamics that nearly destroyed the system in 1998 were amplified through the 2000s. 10 years later, in September 2008, the system collapsed for real. Lehman Brothers failed. AIG required a $182 billion bailout. Bear Stearns, Merrill Lynch, Wachovia, Washington Mutual, all gone. The crisis that almost happened in 1998 happened in 2008 on a scale that made LTCM look tiny. The parallels are exact. Hidden leverage through derivatives, complex mathematical models that failed under stress. Interconnected positions creating systemic risk. Smart people confident in their models until reality broke the assumptions. And too big to fail, forcing government rescue to prevent total collapse. But 2008 wasn't a lesson either. Banks were bailed out. Executives kept bonuses, shareholders were wiped out in some cases, but creditors were made whole. The message, take maximum risk because the downside is socialized while the upside is privatized. By 2021, Archegos Capital Management, a family office using total return swaps, blew up with over $100 billion in hidden exposure. Credit Suisse lost $5.5 billion. Nomura lost $2.9 billion. The same pattern repeated. Hidden leverage through derivatives, concentrated positions, forced liquidation when margins were called. Interconnected counterparty risk, LTCM in 1998, Lehman and AIG in 2008, Archegos in 2021. The cycle repeats because the incentives haven't changed. Financial institutions make money on fees and volume. Leverage amplifies both. Derivatives hide the risk from regulators and sometimes even internal risk managers. When it works, profits are spectacular. When it fails, someone else, taxpayers, depositors, the Fed, covers the losses. The mathematical genius of LTCM's team couldn't prevent failure. The models were elegant. The strategy was sound in normal markets. But finance isn't physics. Markets are human systems. They don't follow mathematical laws. They follow fear and greed. And during crises, fear dominates. Historical correlations break. Liquidity disappears. Models fail. The irony of LTCM having two Nobel Prize winners in economics collapse spectacularly highlights a fundamental truth. Mathematical sophistication doesn't eliminate risk. It often increases it by creating false confidence. The more complex the models, the more assumptions embedded. The more assumptions, the more ways the models can fail. Simplicity is often safer than sophistication. For individual investors, LTCM demonstrates why leverage is dangerous even for geniuses. If the smartest quantitative minds in finance can blow up using 25-to-1 leverage, retail traders using margin should be terrified. Leverage magnifies losses as much as gains, and during volatile periods, small losses become terminal when magnified by borrowing. LTCM also shows why "this time is different" is always a lie. The fund's models were built on recent historical data. The 1990s were calm. Volatility was low. Correlations were stable. The models optimized for that environment. When the environment changed, when Russia defaulted and crisis spread, the models were optimized for conditions that no longer existed. Every financial crisis is preceded by people claiming, "We've learned from past mistakes," or "Our models account for extreme scenarios." But models can't predict black swans, events outside the data used to build them. Russia defaulting in 1998 wasn't in LTCM's models because it hadn't happened before in their data set. The 2008 housing crash wasn't in bank models because nationwide housing price declines hadn't occurred since the Great Depression. The current system has learned nothing. Derivatives exposure is larger than ever. Bank balance sheets are more complex. Leverage remains extreme through repo markets and derivatives. Interconnections have increased through central clearing, but also through new instruments like credit default swaps and collateralized loan obligations. The tools that destroyed LTCM, derivatives, leverage, mathematical models, false confidence, are still dominant in modern finance. The scale is bigger, the complexity greater. The next LTCM is being built right now somewhere. We just don't know where because derivatives hide exposure until it explodes. September 23, 1998 was the day Wall Street's biggest competitors agreed to bail out a hedge fund they all wanted to see fail. They did it because failure meant contagion they couldn't survive. The consortium worked. LTCM was unwound gradually. Markets stabilized. Crisis averted. But the lesson sent to finance was, take maximum risk, because if you're interconnected enough, you'll be rescued. That lesson led directly to 2008, and 2008's bailouts reinforced it further. The cycle continues. The next crisis is inevitable, because the incentives remain unchanged. This is decoded economics. Subscribe to see the risk before it explodes.